Why does a political clash in a country you've never visited suddenly wipe out 5% of your portfolio? It feels random. You check your app, see red everywhere, and the news is talking about a trade dispute or a distant conflict. You start wondering, why does a local event halfway across the world dictate the price of a tech stock in California? Here is the secret. The stock market isn't actually trading companies. It's trading expectations. Think of the market as a giant, high-speed prediction machine. Investors aren't buying a stock for what it is today. They are buying what they think it will be worth in 5 years. Global events are just new data points that change those predictions. Take oil, for example. If there is instability in the Middle East, the market doesn't just worry about the politics. It predicts a supply shortage. That means oil prices spike. Higher oil prices mean higher shipping costs for every single company that moves physical goods. Suddenly, profit margins shrink for thousands of businesses globally, and investors sell off their shares to avoid the coming dip. It's a domino effect. A port closure in Asia isn't just a logistics problem. It's a lower earnings signal for a retail brand in New York. The takeaway? Volatility isn't chaos. It's the market recalculating the future in real time. When you stop seeing the dips as random crashes and start seeing them as the world updating its math, you stop panic selling and start spotting opportunities. Follow for more explainers.